In this video, we are going to talk about my top 3 dividend stocks for 2022. So before starting this video, please like this video and subscribe to our channel for the future updates. Generally speaking, dividend stocks are corporations that distribute a percentage of their profits to a certain class of shareholders on a consistent basis. This kind of company is often well established, with consistent profitability and an established track record of redistributing a portion of those earnings to its shareholders. Dividends are payments that are made to shareholders in the form of cash or extra shares of the company's stock. The majority of dividends are paid out on a quarterly basis, although some are paid out monthly, yearly, or even just once in the form of a special dividend under certain circumstances. While dividend stocks are well known for their consistency in paying dividends, in severe economic times, such distributions may be reduced in order to save cash reserves. The dividend payout ratio is a valuable metric for investors to consider in determining if a company's dividend payments will be sustainable in the long run. The dividend payout ratio is a measure of total dividends divided by net income, which tells investors how much of a company's net income is returned to shareholders in the form of dividends versus how much the company retains to invest in further growth. The dividend payout ratio is calculated by dividing total dividends by net income. If the dividend payout ratio exceeds 100% or is negative, i.e., net income is negative, this implies that the corporation is borrowing money to cover dividend payments. The dividends in these two circumstances are at a higher risk of being reduced than they are in the other. Companies having payout ratios that are either negative or in excess of 100% are excluded from the analysis of the top 5 dividend stocks in the Russell 1000 based on prospective dividend yield. According to the S&P 500 Dividend Aristocrats Index, dividend equities have lagged the wider equity market in recent years. Over the last year, the index has generated a total return of 23.5%, which is lower than the total return of 27.1% generated by the Russell 1000 index. Only one of the dividend stocks listed here has outperformed the overall market during the last year or so. These market performance figures, as well as all other information, are as of December 13, 2021. Concerning the Chowder Rule, DG companies are often screened for potential investment using the Chowder number, C number, which is a prominent growth-oriented indicator. The Chowder measure, named after seeking alpha contributor Chowder, favors dividend growth equities that are expected to provide yearly returns of at least 8%. To calculate the C number, you add the future dividend yield of a company and the yearly dividend growth rate for the last 5 years. Chowder requires a C number of 8 for utilities with a yield of at least 4%, a C number of 12 for stocks with a yield of at least 3%, and a C number of 15 for stocks with a yield of less than 3% for the stocks in question. According to the Chowder Rule, companies in this category are expected to provide yearly returns of at least 8%. I've added a C number column to my spreadsheets, and I've color-coded the cells according to the following scheme. The color green denotes equities that are expected to produce annualized returns of 8%. Yellow signifies that equities have a reasonable chance of delivering an annualized return of 8%. The color red implies that stocks are unlikely to provide annualized returns of 8%. To distinguish between yellow and red prospects, I use a 5-point scale for utilities that yield at least 4%, an 8-point scale for companies that yield at least 3%, and a 10-point scale for stocks that yield less than 3%. Specifically, this article will take a look at 3 dividend companies that might provide a good investment opportunity for income investors in the year 2022. Walmart is a retailer that sells a variety of goods and services, WMT. Walmart is a standout among brick-and-mortar businesses at a time when many are struggling to stay afloat financially. The corporation has a vast retail operation, with roughly 10,500 outlets operating under 48 different banners in 24 different countries across the world. Walmart draws over 220 million people to its shops and internet every week, mostly as a result of its everyday low prices. Walmart has done very well throughout the COVID-19 outbreak. Revenue increased by 4.3% year-on-year to $140.5 billion in the 3 months that ended on October 31, 2021. Notably, Walmart US had a 9.2% increase in comparable store sales, which is a vital indicator of a retailer's health. Aside from that, the corporation has taken advantage of the e-commerce growth, which is typically seen as a threat to traditional stores. Walmart's e-commerce sales in the United States increased by 87% when compared to the same period the previous year. Starting in 1974, the retailing behemoth began paying dividends, and it has raised its payment every year since. Walmart gives a 1.5% annual yield on its stock via a quarterly dividend of 55 cents per share paid out quarterly. Verizon is a telecommunications company based in the United States. VZ, wouldn't it be great if you could obtain some money back from a corporation that you make monthly payments to? Investors may accomplish just that with Verizon, which happens to be one of the biggest telecommunications businesses in the United States, as well as a company that pays high and consistent dividends. Every month, hundreds of thousands of customers pay Verizon to utilize the company's services. Its 4G LTE network currently covers 99% of the population of the United States, and its 5G network has already reached more than 230 million people in the country. With each passing year, Verizon has increased its dividend distribution to the point that it now pays an annual dividend yield of 4.8%, which is a fairly generous amount in today's market. In addition, business is expanding. In the third quarter of 2021, the company's cellular business had a net increase of 699,000 retail postpaid customers. To reach $32.9 billion in the third quarter, total sales increased 4.3% year-on-year. Although Verizon's business has been strong and its dividend distributions have increased, the company's stock has declined by 7% over the last year. Due to the fact that so many companies are trading at new highs, Verizon may provide something to consider for contrarian investors. Ellington Financial Services Incorporated, EFC, for those who find Verizon's 4.8% yield insufficiently tempting, consider Ellington Financial's 5.2% dividend. Based in Old Greenwich, Connecticut, Ellington Financial is a financial services company with a portfolio of financial assets that provide a steady source of revenue. The company then distributes those earnings to stockholders in the form of monthly dividends. Home equity and commercial mortgage loans, mortgage-backed securities, and consumer loans are only some of the types of investments that the corporation has made. Despite the fact that Ellington is not a highly covered financial play, it stands out in today's market owing to the enormous amount of its dividend distribution. In addition to paying a monthly dividend of 15 cents per share, and with a current stock price of $17.55, the firm provides an incredible annual yield of 10.2% on its shares. Ellington Financial produced core profits of $23.0 million, or 46 cents per share, in the third quarter of 2021. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.